Hey everyone, and welcome back to the channel. So the market has been on an absolute run. We've seen the S&P 500 surge for 9 straight days. That's an incredible winning streak, something we haven't seen in a long time. On the surface, everything looks fantastic. It feels like the bull market is back, and maybe, just maybe, we've left all the economic worries behind us. But here's the thing. Whenever you see a move this rapid, this powerful, you have to ask yourself, is this sustainable? Or are we setting ourselves up for another painful rug pull? Is this market euphoria masking some much deeper, more concerning issues that are still bubbling beneath the surface? Because while the headlines are all about new highs, there's a powerful warning coming from some very smart people on Wall Street. A major hedge fund, Apollo Global Management, just put out a presentation that paints a very different picture of the economy than the one the market is currently celebrating. They're not just hinting at a slowdown, they're laying out a roadmap to a potential recession. And in this video, I'm going to break down exactly what Apollo is warning about, why their data is so concerning, and crucially, what it means for your investments. We're going to look at the cracks appearing in consumer spending, the silent impact of tariffs that nobody's talking about enough, and whether the Fed is really going to save us with rate cuts. Plus, I'll give you updates on some key stocks we've been following, and show you how you can use option strategies to protect yourself in this increasingly volatile market. Stick around, because understanding this dynamic is absolutely critical right now. All right, let's dive deep into the heart of this warning from Apollo Global Management. They're a massive investment firm, managing hundreds of billions of dollars, so when they put out a presentation like this, people listen. And their message is clear. The economic signals they're seeing are pointing directly towards a recession. They're not just pulling this idea out of thin air, they're backing it up with cold, hard data. One of the key indicators they highlighted is the ISM Manufacturing Index. Now, this index is a crucial gauge of the health of the manufacturing sector. A reading above 50 generally indicates expansion, while a reading below 50 signals contraction. For months now, the ISM Manufacturing Index has been stuck below 50, and it's not just slightly below 50. It's significantly below, hovering in territory that has historically preceded recessions. Apollo pointed to this persistent weakness as a major red flag. It suggests that businesses are pulling back on production, seeing less demand, and becoming more cautious about the future. This isn't a temporary blip. It's a sustained trend that reflects underlying stress in a vital part of the economy. Beyond manufacturing, Apollo also zeroed in on rising costs for businesses. They presented data showing continued inflationary pressures on the input side, the raw materials and components that companies need to produce their goods. Even as consumer price inflation has cooled somewhat, the costs for businesses haven't dropped as much. This puts companies in a tough spot. They either have to absorb those higher costs, which eats into their profit margins, or pass them on to consumers, which further strains household budgets and potentially reduces demand. Apollo's analysis suggested that many businesses are still grappling with this cost squeeze, and it's impacting their willingness to invest and expand. They showed charts illustrating how various input costs, from energy to certain commodities, remain elevated compared to historical levels. This isn't just an abstract concept. It translates directly into pressure on earnings and operational efficiency for countless companies. Perhaps one of the most compelling data points Apollo presented was the decline in shipping activity. Think about it. If the economy is booming and demand is strong, goods need to be shipped around the world. Ports are busy, container ships are full, and logistics companies are working overtime. But Apollo's data showed a noticeable and sustained decline in key shipping metrics, particularly for container shipping. They presented graphs showing the decrease in volume and, in some cases, the drop in shipping rates, which is often a reflection of reduced demand. This decline in shipping isn't just a minor detail. It's often seen as a leading indicator of global economic activity. If fewer goods are being shipped, it strongly suggests that either production is falling or consumer demand is weakening, or both. Apollo used this data to argue that the physical movement of goods, the lifeblood of global commerce, is signaling a slowdown that the market is currently ignoring. They highlighted specific routes and metrics, like the Shanghai Containerized Freight Index, which, while volatile, has shown trends consistent with a global demand deceleration. They emphasized that this isn't just a seasonal dip, it's a more fundamental shift in the volume of trade. Apollo's presentation also touched on the inversion of the yield curve, a classic recession indicator that has been flashing red for a long time, but they integrated it with these other points to build a more comprehensive picture. They argued that the persistent inversion, where short-term Treasury yields are higher than long-term yields, isn't just a quirky market phenomenon. It reflects bond investors' expectations of slower growth and potential rate cuts in the future. When you combine that with declining manufacturing, persistent cost pressures on businesses, and falling shipping volumes, the picture becomes much clearer. Apollo's thesis is that these are not isolated issues. They are interconnected signals that, when viewed together, form a compelling case for an impending economic contraction. Their presentation wasn't just a collection of negative data points. It was a narrative built on how these indicators interact and reinforce each other, creating a feedback loop that leads towards weaker economic activity. They showed how declining factory orders lead to less need for shipping, which in turn impacts transportation companies and so on. They also included historical data points, showing how the current levels of the ISM Manufacturing Index, shipping volumes, and yield curve inversion have consistently preceded recessions in the past. They weren't saying this time is different. They were arguing that the historical precedents are strong and should not be dismissed. They presented charts overlaying these indicators with past recessionary periods, demonstrating a clear correlation. This historical context added significant weight to their argument. It wasn't just about current data. It was about how this data fits into a long-term pattern of economic cycles. Apollo's team clearly put a lot of work into compiling and presenting this data in a way that was both comprehensive and easy to understand, even for those not deeply immersed in economic indicators. They used clear visuals, graphs, charts, and data tables to make their points undeniable. Furthermore, Apollo highlighted the potential for policy missteps. They suggested that while the Federal Reserve is trying to manage inflation and employment, the current economic signals are complex and contradictory. They argued that the lag effects of past interest rate hikes haven't fully played out yet, and that the economy may be slowing down more rapidly than the Fed currently perceives. This adds another layer of risk, as a disconnect between the Fed's actions and the on-the-ground economic reality could exacerbate any downturn. Apollo's presentation suggested that the market might be too optimistic about the timing and extent of future rate cuts, and this optimism could be quickly dashed if the economic data continues to deteriorate in the ways they anticipate. They dedicated a section to the potential for a hard landing scenario, where the economy enters a recession rather than achieving a smooth, soft landing envisioned by some. They argued that the indicators they presented make the hard landing scenario increasingly probable. In essence, Apollo Global Management is waving a big yellow flag, urging investors not to be lulled into a false sense of security by the recent market rally. They're saying, look beyond the headlines and look at the underlying economic fundamentals. Their presentation serves as a stark reminder that the real economy, the one driven by manufacturing, shipping, and business investment, may be much weaker than the stock market currently reflects. They are advocating for caution and a defensive posture, suggesting that the current environment is one where capital preservation should be a higher priority than chasing speculative gains. They concluded their economic section with a call for vigilance, recommending that investors pay close attention to these key indicators in the coming months. Their message is clear. The roadmap to a recession is being laid out by the data, and it's time to pay attention. Moving on from Apollo's deep dive into the macroeconomic signals, let's talk about something much more tangible for all of us, the consumer. Because ultimately, a huge portion of the U.S. economy is driven by consumer spending. If people are feeling confident, if they have money in their pockets, and if they're willing to spend, the economy generally hums along. But if that confidence starts to crack, if debt levels become a burden, and if people pull back on discretionary spending, that's when you start to see the leading edge of a recession. And right now, the data on the consumer side is starting to look increasingly concerning. One of the most widely watched indicators of consumer sentiment is the University of Michigan Consumer Sentiment Index. This survey asks people how they feel about their current financial situation and their expectations for the future economic environment. And for months, this index has been hovering at historically low levels. We're not talking about a slight dip. We're talking about sentiment readings that are comparable to, or even lower than, what we saw during the depths of the global financial crisis in 2008. Think about that for a second. People are feeling about as pessimistic about the economy now as they did when the entire financial system was on the brink of collapse. This persistent low level of sentiment is a major red flag. It suggests that despite low unemployment numbers, people are feeling the pinch of inflation, they're worried about job security, and they're uncertain about the future. This lack of confidence can quickly translate into reduced spending, as people become more cautious with their money, choosing to save rather than splurge. Adding to this concern is the alarming rise in credit card debt. Americans have been leaning heavily on credit cards to maintain their spending levels in the face of persistent inflation. Total credit card debt in the U.S. has soared to record highs, surpassing the $1 trillion mark. While using credit is a normal part of the economy, the speed and magnitude of this increase are worrying. It suggests that a significant number of households are struggling to make ends meet with their current income and are resorting to borrowing to cover essential expenses. As interest rates have risen, the cost of carrying this debt has also increased significantly, putting further pressure on household budgets. This rising debt load acts like a drag on future spending, as more and more of people's income is diverted to servicing debt rather than buying goods and services. It's a precarious situation, as any job loss or unexpected expense could quickly push families into financial distress. We're also starting to see anecdotal evidence of this pullback in spending from major companies. Companies that are typically seen as bellwethers for consumer health are reporting early signs of weakness. Take Chipotle, for example. While still a popular chain, they've indicated that they're seeing some price sensitivity from consumers. People might be ordering fewer extras, opting for slightly cheaper options, or visiting less frequently. This isn't a full-blown collapse in demand, but it's a subtle shift that reflects consumers being more mindful of price and value. Pepsi, the beverage and snack giant, has also talked about consumers trading down to less expensive options or being more selective about their purchases. This kind of behavior change, even if gradual, can have a significant impact on the sales and profitability of companies that rely on consistent consumer demand. Even in the travel sector, which has been relatively strong, we're seeing some cracks. Southwest Airlines, for instance, has mentioned some softness in leisure travel demand, particularly in certain markets. While business travel might be holding up, a pullback in leisure travel suggests that consumers are becoming more cautious about discretionary spending, prioritizing necessities over vacations and other non-essential expenses. These examples from different sectors, restaurants, consumer staples, and travel, are important because they provide real-world confirmation of the trends suggested by the broader economic data and the low consumer sentiment numbers. They show that the theoretical concerns about consumer weakness are starting to manifest in actual business performance. Connecting this back to the Apollo report, the weakness in consumer spending is a critical piece of the recession puzzle. If consumers pull back, it directly impacts businesses, from small local shops to large multinational corporations. Lower sales lead to reduced production, which ties back to the weak ISM manufacturing data Apollo highlighted. It can also lead to job losses as businesses cut costs, which further erodes consumer confidence and spending, creating a negative feedback loop. The rise in credit card debt is particularly concerning because it limits consumers' future ability to spend and makes them more vulnerable to economic shocks. Apollo's analysis of the broader economic indicators combined with these emerging signs of consumer weakness paints a picture of an economy that is losing momentum from both the supply side and the demand side. The risk here is that the market is currently overlooking the fragility of the consumer. The recent rally might be driven by optimism about the Fed or excitement about specific sectors like technology, but it's not necessarily reflecting a fundamental strengthening of the consumer base. If consumer spending continues to weaken, companies will start to miss earnings expectations, and that could quickly lead to a market correction. The signs are there: persistently low sentiment, record credit card debt, and leading companies reporting signs of pullback. These aren't things to ignore. They are crucial indicators that the economic foundation might not be as strong as the stock market currently suggests. Paying attention to these consumer trends is essential for understanding the true state of the economy and preparing your portfolio for potential turbulence ahead. Now, let's shift gears and talk about a factor that is quietly but significantly impacting the U.S. economy and contributing to the potential for a recession: tariffs. For years now, tariffs have been a part of the global trade landscape, particularly those implemented on goods imported from China. While they might seem like a distant policy issue, their effects are very real and are increasingly being felt by U.S. businesses and consumers. Tariffs are essentially taxes on imported goods. The intention is often to make domestically produced goods more competitive or to pressure other countries into changing their trade practices. However, the reality is that these costs are often passed on, either directly to consumers in the form of higher prices or absorbed by businesses, which impacts their profitability and investment decisions. The impact of tariffs is significant and growing. For businesses that rely on imported components or finished goods, tariffs increase their cost of doing business. If a manufacturer in the U.S. imports a specific part from China to assemble a product, the tariff adds a direct cost to that part. This either forces the manufacturer to raise the price of the final product, making it less competitive, or to accept lower profit margins. Over time, this pressure can become unsustainable, leading businesses to cut back on production, delay investments, or even consider relocating parts of their supply chain, which is a complex and expensive process. The longer tariffs remain in place, the deeper their impact becomes on business operations and financial performance. Supply chain disruptions have also been a major consequence of tariffs, especially those on goods from China. Companies that had long-established relationships with Chinese suppliers have had to scramble to find alternatives. This can be challenging, as finding suppliers with the same quality, scale, and cost-effectiveness is not always easy. Shifting supply chains takes time and effort, and it can lead to delays, increased logistics costs, and uncertainty. While some companies have partially reshored or friendshored their supply chains, this transition is far from complete and continues to be a source of disruption and added cost. The reliance on global supply chains built over decades cannot be easily undone, and tariffs make this process more painful and costly for businesses. The most direct impact on consumers comes in the form of higher prices. When tariffs are applied to goods we buy, whether it's electronics, clothing, or household items, the cost is often passed on to us. This contributes to the inflationary pressures that consumers have been experiencing. While overall inflation might be moderating, tariffs are a persistent source of upward pressure on the prices of specific goods. This means that even if other factors are helping to bring inflation down, tariffs are working against that trend, keeping prices higher than they otherwise would be. This reduces the purchasing power of consumers and further strains household budgets, especially when combined with rising credit card debt and stagnant real wages for many. We're seeing leading retailers and consumer brands increasingly talk about the impact of tariffs on their business. Companies like Ralph Lauren have highlighted how tariffs add costs to their imported apparel and accessories. While they may try to absorb some of these costs or find alternative sourcing, it's a continuous challenge that impacts their profitability and pricing strategies. Similarly, Lululemon, known for its premium athletic wear, has faced increased costs due to tariffs on goods imported from China. Even for companies with diversified supply chains, a significant portion of global manufacturing still takes place in China, making them vulnerable to these trade barriers. Nike, a global sportswear giant, has also commented on the challenges posed by tariffs and the complexity of managing their vast supply chain in this environment. These examples from major consumer-facing companies illustrate that tariffs are not just abstract economic concepts. They have a direct impact on the products we buy and the prices we pay. The silent nature of the tariff impact makes it particularly insidious as a recession driver. It's not a sudden shock like a financial crisis. It's a slow, cumulative drag on the economy. It increases costs for businesses, which reduces their willingness to invest and hire. It increases prices for consumers, which reduces their purchasing power and willingness to spend on discretionary items. It disrupts supply chains, creating uncertainty and inefficiency. While each individual tariff might seem minor, their combined effect over time is significant. They act as friction in the economic engine, slowing down growth and making businesses and consumers more vulnerable to other economic headwinds. Apollo Global Management likely considers the cumulative impact of these tariffs as a contributing factor to the broader economic slowdown they are forecasting. It's another piece of the puzzle that suggests the current economic environment is more challenging than the recent stock market rally implies. The ongoing nature of these tariffs means their impact isn't going away anytime soon. Unless there's a significant shift in trade policy, businesses will continue to grapple with these added costs and supply chain complexities. This ongoing pressure makes it harder for the economy to regain momentum and increases the risk of a downturn. For investors, it's important to recognize that tariffs are a persistent headwind for many companies, particularly those with significant international supply chain exposure. This factor needs to be considered when evaluating the future earnings potential and growth prospects of businesses. Ignoring the impact of tariffs is like ignoring a steady leak in the foundation of a house. It might not cause immediate collapse, but it weakens the structure over time and makes it more susceptible to damage from other sources. Understanding the silent, pervasive impact of tariffs is crucial for accurately assessing the current economic risks and positioning your portfolio accordingly. Now, let's turn our attention to the Federal Reserve and the current market expectations surrounding their policy. This is a crucial piece of the puzzle because the Fed's actions have a massive influence on interest rates, borrowing costs, and ultimately, the overall economic environment. For months, the market has been largely operating under the assumption that the Fed is done hiking interest rates and that rate cuts are not only coming, but coming relatively soon. This expectation of future rate cuts has been a significant tailwind for the stock market, as lower interest rates generally make stocks more attractive relative to bonds and reduce borrowing costs for companies. However, there's a growing disconnect between these market expectations and the economic realities that are still unfolding. While inflation has come down from its peak, it's still above the Fed's 2% target, and recent economic data has been somewhat mixed. We've seen a surprisingly strong jobs report recently, which on the surface suggests a robust labor market. A strong labor market is generally not consistent with the need for immediate rate cuts. The Fed has repeatedly stated that their decisions will be data-dependent, and a tight labor market with upward pressure on wages could make them hesitant to lower rates too quickly. They don't want to risk reigniting inflationary pressures. The strong jobs report, while positive for employment, complicates the narrative of an economy rapidly slowing down to the point where aggressive rate cuts are needed. It suggests the Fed may have less room to ease policy than the market believes. Furthermore, the Fed has emphasized that they want to see convincing evidence that inflation is sustainably moving back towards their target. They're looking beyond just a few months of good data. They want to be confident that the trend is firmly in place. The recent strength in the labor market and the persistence of some inflationary pressures, as highlighted by Apollo's report on business costs and the ongoing impact of tariffs, suggest that the Fed might need more time to be fully convinced. They have communicated a cautious approach, emphasizing the need to avoid cutting rates too early and potentially undoing the progress made on inflation. This cautious stance is often overlooked by a market that is eager for the stimulus of lower rates. Another key indicator to watch is the 10-year Treasury yield. This yield is often seen as a benchmark for long-term borrowing costs and a reflection of market expectations for future economic growth and inflation. Despite the recent stock market rally and expectations of rate cuts, the 10-year Treasury yield has remained relatively high. It hasn't plummeted in the way you might expect if the market was truly anticipating a rapid series of aggressive rate cuts and a significant economic slowdown. A persistently elevated 10-year yield suggests that the bond market, which is often seen as more forward-looking and less prone to speculative swings than the stock market, is not fully buying into the narrative of imminent and deep rate cuts. It could reflect ongoing concerns about inflation, the sheer amount of government debt being issued, or a belief that the economy, while slowing, might not be on the verge of a sharp recession that would necessitate emergency rate cuts. The looming disconnect is this. The stock market seems to be pricing in a scenario where inflation continues to fall, the economy slows just enough to warrant rate cuts, but not so much that it enters a recession, and corporate earnings remain relatively resilient. This is a bit of a Goldilocks scenario, not too hot, not too cold, and it's arguably overly optimistic given the data presented by Apollo and the emerging signs of consumer weakness and tariff impacts. If the economy continues to slow in the ways Apollo and others are forecasting, and the Fed is slower to cut rates than the market expects due to lingering inflation concerns or a still strong labor market, that could lead to significant market disappointment. This disappointment could trigger a sharp correction, as investors are forced to reevaluate their assumptions about future interest rates and economic growth. The Fed is in a difficult position. They are trying to balance battling inflation with avoiding a severe recession. Their communication has been carefully worded, emphasizing flexibility and data dependence. However, the market often tends to latch onto the most optimistic interpretation of their statements. The risk is that the market has gotten ahead of itself in expecting rapid and deep rate cuts, and that the underlying economic reality, characterized by slowing growth, consumer fragility, and persistent cost pressures, doesn't support that optimistic scenario. This potential for market disappointment regarding Fed policy is a significant risk factor that investors need to be aware of. It highlights the fragility of the current market rally, which seems heavily reliant on the expectation of a Fed pivot that may not come as quickly or as aggressively as hoped. Paying close attention to the Fed statements, the inflation data, and the jobs reports is crucial, but also understanding the potential divergence between market expectations and the Fed's likely actions based on the data is paramount in navigating this environment. All right, let's pivot from the big macroeconomic picture to some specific stocks that we've been following and that are particularly relevant in this current environment. Understanding the broader economic trends is crucial, but applying that understanding to individual companies is where you make investment decisions. We're going to look at updates on Supermicro Computer, AMD, SoundHound AI, and the trade desk. First up, Supermicro Computer, or SMCI. This stock has been on an absolute tear, largely driven by the explosion in demand for AI infrastructure. They make servers and storage solutions that are essential for powering AI applications. The investment thesis here has been straightforward. AI requires a massive amount of computing power, and SMCI is a key provider of the hardware that makes that possible. Recently, SMCI had its earnings report, and it was, again, incredibly strong. They beat expectations on both revenue and earnings and provided very robust guidance for the future. This confirmed that the demand for their products in the AI space remains exceptionally high. Their ability to quickly get their high-performance server solutions to market has given them a significant advantage. They've been able to capitalize on the urgent need from companies building out their AI capabilities. However, with such a massive run-up in the stock price, the valuation has become a major consideration. While the growth is undeniable, the stock is now trading at a very high multiple of its earnings and sales. This doesn't mean the stock can't go higher, especially if the AI boom continues unabated. But it does mean that the margin of safety is reduced. Any stumble in earnings, any sign of slowing demand or increased competition could lead to a significant pullback. The outlook remains positive based on their recent performance and guidance, with price targets ranging widely depending on how aggressively analysts project future growth. Some are seeing targets well above current levels, while others are more cautious given the rapid ascent. The key here is that the fundamental thesis of SMCI benefiting from AI infrastructure demand is playing out as expected, but the valuation adds a layer of risk for new investors at these elevated levels. Next, let's talk about AMD, another semiconductor company deeply involved in the AI race, but also with significant exposure to other markets like PCs and gaming. AMD has been seen as a key competitor to NVIDIA in the AI chip space with their Instinct accelerators. Their recent earnings report was a bit more mixed than SMCI's. While their data center business, which includes their AI chips, showed strong growth, other segments like gaming and embedded were softer. This highlights AMD's broader exposure to different parts of the technology market. The investment thesis for AMD is that they are a formidable competitor across multiple fronts: CPUs, GPUs, and increasingly, AI accelerators. They've been gaining market share from Intel in CPUs and are positioning themselves as a strong alternative to NVIDIA in AI. The outlook for AMD is somewhat dependent on the pace of adoption for their AI chips and the recovery in their other segments. They provided guidance that suggested continued growth in data center, but perhaps not at the explosive pace seen in some other AI pure plays. Price targets for AMD also vary, reflecting the different views on their competitive position in AI and the performance of their non-data center businesses. Some analysts see significant upside as their AI chips gain traction, while others are more cautious given the competitive landscape and the softness in other areas. The key takeaway here is that AMD is a diversified technology company with a significant AI opportunity, but their performance is tied to multiple market cycles. Moving on to SoundHound AI, SOUN. This is a smaller company focused on voice AI and conversational intelligence. They provide solutions that allow businesses to integrate voice recognition and natural language understanding into their products and services. The investment thesis here is centered on the growing importance of voice interfaces in various applications, from cars to customer service. Recently, SoundHound had a pre-announcement that sparked significant interest. They indicated strong progress and potentially better than expected results, which sent the stock soaring. This pre-announcement suggested that their technology is gaining traction and that they are securing important partnerships and contracts. The outlook for SoundHound is highly dependent on their ability to continue winning new customers and scaling their technology. They are in a rapidly evolving market with larger competitors, so execution is critical. The recent pre-announcement validates their progress, but they are still a relatively early-stage growth company. Price targets for SOUN reflect the speculative nature of the investment, with some analysts seeing significant long-term potential if they can capture a meaningful share of the voice AI market, while acknowledging the inherent risks. The key here is that SoundHound represents a play on the broader trend towards voice interfaces, and the recent news is a positive signal, but it's a higher risk, higher reward opportunity compared to established tech giants. Finally, let's look at the trade desk, TTD. This company operates in the programmatic advertising space, providing a platform for buyers of digital advertising. The investment thesis for TTD is that the shift of advertising budgets from traditional media to digital and connected TV will continue, and TTD is well positioned to benefit from this trend. They offer an independent platform that provides transparency and control for advertisers. Recent updates from TTD have generally been positive, highlighting the continued growth in programmatic advertising, particularly in CTV. They've been emphasizing their focus on providing better measurement and targeting capabilities for advertisers in this evolving landscape. The outlook for the trade desk remains strong based on the secular trend towards digital and CTV advertising. However, as an advertising technology company, their performance can be sensitive to the broader economic environment. If the economy slows down significantly, companies may cut back on advertising spending, which could impact TTD's growth. Price targets for TTD are generally optimistic, reflecting the strong growth trajectory of programmatic advertising and TTD's leading position in the independent ad tech space. The key here is that TTD is benefiting from a powerful long-term trend, but they are not immune to potential headwinds from a weaker economy. Monitoring overall advertising spending trends will be important for assessing TTD's near-term prospects. Overall, while the market has rallied, examining these specific stocks shows that the picture is nuanced. Companies tied directly to the strongest secular trends like AI are still seeing strong performance, but valuation is a concern. Companies in earlier growth stages are showing promise but carry higher risk. And companies benefiting from long-term shifts are well-positioned, but exposed to the broader economic cycle. Navigating this environment requires understanding both the macro risks we discussed earlier and the specific fundamentals and valuations of individual companies. Given the potential for increased volatility and downside risk in the market, as highlighted by the Apollo report and other economic indicators, it's more important than ever to think about risk management. This isn't about being overly bearish or predicting a market crash with certainty, but rather about being prepared for different scenarios. One powerful tool that can help you manage risk and potentially even profit in a volatile or declining market is options. Options are financial contracts that give you the right, but not the obligation, to buy or sell an underlying asset at a specific price on or before a certain date. There are various option strategies you can use, but two that are particularly relevant for risk management in the current environment are selling covered calls and using bear spreads. Let's talk about selling covered calls first. This is a strategy often used by investors who own shares of a stock. When you sell a covered call, you are selling someone else the right to buy your shares at a specific strike price before the expiration date. In return for selling this right, you receive a premium, a cash payment up front. The benefit of selling covered calls is that you generate income from your existing stock holdings. If the stock price stays below the strike price, you keep the premium and your shares. If the stock price goes above the strike price, your shares might be called away, meaning you have to sell them at the strike price. This strategy is useful in a market where you expect the stock price to either trade sideways or experience a modest decline. It allows you to generate income and partially offset potential small losses, while still participating in some upside up to the strike price. We've seen examples of this strategy being applied to stocks like SMCI. Given the massive run-up in SMCI's price, some investors who own the stock might be concerned about a potential pullback. By selling covered calls at a strike price above the current market price, they can generate income while still giving themselves room for the stock to appreciate further. If the stock continues to climb, their shares might be called away, but they would still profit from the appreciation up to the strike price plus the premium received. If the stock consolidates or pulls back slightly, they keep the premium, which helps cushion any decline in the stock price. It's a way to be a little more conservative after a big rally while still holding onto your shares. Another strategy is using bear spreads. Bear spreads, specifically bear put spreads or bear call spreads, are option strategies that are profitable if the underlying asset declines in price. A bear put spread, for example, involves buying a put option at a specific strike price and selling a put option at a lower strike price, both with the same expiration date. This strategy has a limited profit potential and a limited risk potential. It's useful when you anticipate a moderate decline in the price of an asset, but don't want to risk a large amount of capital. You are essentially betting on the price falling to or below the higher strike price, but not necessarily collapsing completely. This strategy could be applied to an ETF like SPY, which tracks the S&P 500. If you are concerned about a potential market correction based on the economic data we've discussed, you could implement a bear put spread on SPY. You would buy a put option with a strike price slightly below the current market price and sell a put option with an even lower strike price. If the S&P 500 declines, your bought put option will increase in value, while your sold put option will increase less, resulting in a net profit. The maximum profit is limited to the difference between the strike prices minus the cost of setting up the spread, and the maximum loss is limited to the cost of setting up the spread. This is a way to hedge your portfolio against a market downturn without taking on unlimited risk. Using options for risk management requires understanding how they work and the specific risks involved with each strategy. It's not about making massive speculative bets. It's about using these tools strategically to protect your portfolio and potentially generate income in uncertain markets. Selling covered calls is a way to enhance yield on your existing holdings, while bear spreads are a way to gain from a declining market with defined risk. For those who want to delve deeper into options and learn how to implement these and other strategies, I highly recommend checking out our options course. It's designed to take you from the basics to more advanced concepts, helping you understand how to use options for income generation, risk management, and even directional trading with defined risk. Learning about options can be invaluable in navigating volatile markets like the one we might be entering. They provide flexibility and the ability to tailor your exposure to specific market views, whether you're looking for income, protection, or speculative opportunities with controlled risk. Understanding options is a powerful addition to any investor's toolkit, especially when the economic outlook is as uncertain as it appears to be right now. As we look ahead, there are key events on the horizon that could provide more clarity on the state of the economy and the potential for a recession. One of the most important periods to watch will be the upcoming earnings reports from major retailers. Retailers are on the front lines of consumer spending, and their results can provide valuable real-time insights into the health of the consumer and the impact of factors like inflation, rising debt, and tariffs. We're going to be paying particularly close attention to the reports from companies like Crocs and Hanes. Crocs, the company known for its distinctive foam clogs, is an interesting barometer. While they have expanded their product line, their core product is still somewhat discretionary, though they have built a strong brand loyalty. Their earnings report will be important for several reasons. First, it will tell us how consumer demand for their products is holding up. Are people still buying new pairs of Crocs and their related products, or are they cutting back on non-essential footwear? Second, it can provide insights into the impact of costs and pricing. Are they successfully passing on higher costs to consumers through price increases, or are they having to absorb them, which would compress their margins? Their commentary on inventory levels will also be crucial. Are they sitting on excess inventory, suggesting weaker than expected demand, or are they managing it effectively? Crocs has also been expanding internationally, so their results can offer a glimpse into consumer behavior in other markets as well. Watching their sales trends, profit margins, and inventory will give us a sense of how consumers are prioritizing discretionary spending in the current economic climate. Hanes International, on the other hand, is a different kind of company, but equally important for understanding economic trends. Hanes is a producer of high-performance alloys, used in industries like aerospace, chemical processing, and industrial gas turbines. Their earnings report can serve as an indicator of activity in these key industrial sectors. Demand for high-performance alloys is often tied to capital spending and production in these areas. If Hanes reports strong results and a positive outlook, it could suggest that industrial activity is holding up reasonably well, at least in the sectors they serve. Conversely, if they report weakening demand or a cautious outlook, it could signal a slowdown in these critical areas of the economy. Their commentary on order backlogs and lead times will be particularly informative. Are companies still placing large orders for these alloys, or are they delaying or canceling projects? Beyond these two, specific companies, watching a range of retailers, from discount stores to high-end luxury brands, will provide a comprehensive picture of consumer behavior across different income levels. Are consumers trading down to cheaper options? Are they delaying large purchases? Are they cutting back on discretionary items altogether? These are the questions that earnings reports from retailers can help answer. Their commentary on foot traffic, online sales trends, average transaction values, and promotional activity will all be important clues. Pay attention to what they say about the impact of inflation on their customers and their own cost structure. Are they seeing any relief in supply chain costs, or are tariffs and other factors keeping costs elevated? The upcoming earnings season for retailers and industrial companies will be a critical period for validating or contradicting the recessionary signals we've discussed. If a broad range of retailers report weakening demand and cautious consumer behavior, it will strongly support the view that the consumer is pulling back, which is a key ingredient for a recession. If industrial companies like Hanes start reporting significant slowdowns in their order books, it would suggest that businesses are becoming more hesitant to invest and expand, further reinforcing a recessionary outlook. These earnings reports are not just about the performance of individual companies. They are valuable data points for understanding the broader economic landscape. Based on the analysis we've covered, the warnings from Apollo Global Management, the cracks appearing in consumer confidence and spending, the silent drag of tariffs, and the potential disconnect between Fed expectations and economic reality, the overall market outlook points towards an increased risk of a correction or a more significant downturn in the coming months. While the recent 9-day rally in the S&P 500 has been impressive, it feels increasingly like a relief rally driven by hopes of Fed rate cuts and excitement over specific sectors, rather than a reflection of fundamental economic strengthening. The underlying economic data, particularly the leading indicators and the anecdotal evidence from businesses, suggests a more challenging environment ahead. So, what are the actionable steps you can take to prepare for this potential next phase? First and foremost, maintain a degree of caution and don't get caught up in the euphoria of the rally. Avoid the temptation to chase every upward move, especially in highly speculative areas. The market can be fickle, and gains made quickly can be lost even faster in a downturn. This doesn't mean you should sell everything and go to cash, but it does mean being selective and thoughtful about your investments. Consider maintaining a higher than usual allocation to cash or high-quality short-term bonds. Having some liquidity provides flexibility. It allows you to ride out potential market volatility without being forced to sell assets at unfavorable prices, and it positions you to take advantage of potential buying opportunities if the market does correct. Holding some cash in a high-yield savings account or short-term treasuries currently offers a decent return while providing safety. Avoid taking on excessive leverage. Borrowing money to invest magnifies both gains and losses. In a potentially declining market, leverage can quickly turn a moderate loss into a devastating one. Be prudent with margin and other forms of investment-related debt. Review your portfolio and assess its risk profile. Are you overly concentrated in sectors or individual stocks that are highly sensitive to economic downturns? Consider diversifying your holdings and potentially rotating into more defensive sectors that tend to perform relatively better during recessions, such as consumer staples, healthcare, or utilities. Rebalancing your portfolio to align with your risk tolerance and long-term investment goals is especially important in uncertain times. As we discussed earlier, explore using option strategies for risk management. Selling covered calls on some of your existing positions can generate income and provide a small buffer against potential declines. If you are concerned about a broader market downturn, using bear put spreads on indices like the S&P 500 or NASDAQ 100 can provide downside protection with defined risk. These strategies are not about predicting the exact timing or magnitude of a downturn, but about building resilience into your portfolio. Think of them as insurance policies. Importantly, maintain a long-term perspective. Market corrections and recessions are a normal part of the economic cycle. While they can be painful in the short term, historically, the market has always recovered and gone on to reach new highs. Don't let short-term volatility derail your long-term investment plan. Continue to focus on your financial goals and stick to a disciplined investment approach. For long-term investors, Downturns can even present opportunities to buy quality assets at discounted prices. Finally, stay informed. Continue to follow economic data, earnings reports, and market developments, but interpret them through a critical lens, taking into account the potential disconnect between market sentiment and underlying fundamentals. Being informed allows you to make more rational decisions and avoid being swayed by short-term market swings or emotional reactions. The information we've discussed today, from the Apollo warning to consumer trends and tariff impacts, provides a valuable framework for understanding the current environment. To stay on top of all these developments, to connect with other investors, and to share insights, I encourage you to join the community on Blossom. It's a great platform to discuss market trends, share your portfolio, and learn from others. You can find the link to download the app in the description below. Staying connected and informed is crucial in this environment. Remember the importance of long-term investing. Focus on compounding your capital over time. Avoid getting caught up in the short-term noise. If you found this video helpful, please give it a thumbs up and subscribe to the channel for more in-depth market analysis. And let me know in the comments below what you think about the current market and your own strategies for navigating potential volatility. Your engagement helps the channel grow and allows us to continue providing valuable content. Thank you for watching, and I'll see you in the next video.